Hello, and welcome to today's presentation. Today, we'll be talking about lease loan financing. Today's date is the 27th of May, 2019. I must stress this is for educational purposes only, and is not to be used as financial advice. Let us start. So, today we'll be talking about a couple things, but specifically what we're talking about is what is equipment and lease loan financing. We will then talk about the businesses that are capable of applying for such financing and why they should. And thirdly, what information is required to make such an application. At the end, we will then look at the details of a lease loan finance, specifically covering interest, loan terms, and such like that. So, what is equipment finance and lease finance? Equipment finance is a form of business finance which allow businesses to purchase or lease equipment unsecured. There are many forms which will be talked about today. So, firstly, you can see we have 5 listed here. The first of which is a chattel mortgage, also known as equipment loan. This is a financing arrangement where a borrower purchases chattel by taking a loan from the lender, which also serves as security for the loan. The ownership of the chattel is transferred to the borrower right after the purchase. This allows the borrower to own the item and also be able to claim any interest charges and depreciation of assets as tax deductions. We then have commercial hire purchase. Unlike a chattel mortgage, the lender agrees to purchase the property, allowing the borrower to hire the equipment for a fixed monthly repayment over a specific period of time, even though the borrower is in possession. Ownership lies with the lender, with legal ownership transferring after all dues are paid. This benefits businesses who want to own the latest equipment but wish to preserve their available cash. It is also beneficial for businesses which account for GST payments, as tax deductions can also be claimed. Thirdly, we have equipment lease, which is also known as finance lease arrangement. This is very similar to a commercial hire purchase, except that the business won't take the equipment at the end of the lease contract. Also, there is a form called fully maintained equipment lease, where in addition to leasing the equipment, the lender will provide financing for costs related to operating and owning it. For example, for a car, fuel costs, servicing, registration fees, and other permits. At the end of the equipment lease, the rental will have a residual value which provides the borrower the option to purchase equipment at the end of the lease period. The lease payment can be claimed as a tax deduction. This benefits businesses who do not want equipment all year round, as they may require frequent equipment upgrades. Thus, they can lease it and do not have to own it at the end of its period, but are provided the option to with a residual value amount that has to be paid. The equipment, this may be because the equipment will depreciate and may be difficult to sell for the borrower. And fourthly, we will look at equipment rentals. This is where property is bought by the lender and it is then rented by the business for a given period of time, very similar to equipment lease. However, unlike equipment lease, it is a month-to-month type arrangement, and after a month, changes can be made to the agreement by either party abiding by the applicable notice periods. This benefits businesses with limited resources and an unstable monthly revenue. And finally, we look at structured loans. Structured loans benefit businesses with a complex financial situation that other financing products cannot solve. This can be provided to business with poor cash flow, bad credit history, and what other lenders would consider high risk. Thus, these type of loans have a much higher interest rate to compensate for the higher risk they are willing to bear and are generally for a shorter loan term. Out of these 5, the 2 most common ones that we look at generally are chattel mortgage and equipment lease financing. So, what businesses are capable of applying? Short answer, any business that requires equipment. Any businesses that benefit from equipment finance are businesses which do not have enough available cash to consider an outright purchase. However, if one can afford it, investing cash in assets leaves the business with less working capital to finance operations or explore new growth opportunities. Thus, lease loan financing allows businesses to free up their cash to use on growth, with a bonus of tax deductions depending on the form of loan. When the lender offers a loan, however, it is secured against the equipment, and so the amount of finance cannot exceed the collateral value. The length of the term will also not exceed the length of the economic useful life of the financed equipment. And as we said, any business can apply, which requires equipment. However, the ones at Zank that we are more familiar with are in the hotel and restaurant space, specifically in regards to restaurants, ones with a franchise agreement. Hotels and restaurants do not need to be a part of a franchise. However, it is highly recommended they are, as it will make the process much smoother, especially for restaurants. If the restaurant, especially, is not part of a franchise, then if they are requiring fit out and fittings finance, then it will be a 1-to-1 ratio with the amount of equipment they are seeking. Next, what information is required to prepare an application for finance? So, in general, like all business and commercial loans, receiving approval for an equipment finance depends largely on the strength of your case and is done generally on a case-by-case basis. However, generally, they will always look at basically whether interest payments can be paid, looking at the health of the company and also the expertise of the borrower. First, they look at the business experience of the borrower, the type of business that is being run, particularly if it is in a high-risk sector. They'll also look at the business profitability and cash flow position, and also the type of equipment that you want to finance to ensure that this is one that they're comfortable with. They also look at the interest coverage ratio, which is based on the income to debt ratio. So, when you seek out a new borrower, these are the initial questions that need to be asked. Specifically, what is the franchise you're with, if you're with any? Are you an Australian citizen or PR? The summary of your prior work experience and how long you have owned the business for, the business name and ABN of the business that is applying for the loan, the status of the business premises, whether it is leased or the land owned outright, the location of the business premises, how much funding they are requiring, their business plans and the reason for the loan, and how they plan on paying for non-refurbishment fees. Non-refurbishment fees that the lender is unwilling to lend for. So, these are the documents that are required to back up the loan. And they are as you can see, they're in stages, where stage 1 is the initial stage of the application, where it's passed to the lender. This is a very general one, which allows them to provide a quick quote. Stage 2 is where more documents are needed to be provided for the lender to understand the strength of the business and whether they are willing to provide the loan at all. And finally, stage 3 is when the contract is being drawn up and they require to know what they are funding. So, at stage 1, it's very general information. Verification of identification in the form of Medicare and driver's license on both sides. The personal A&L statement of the director. At this stage, it only needs to be a general one and does not require to be certified, however will be required to be at a later stage. The invoice of works. This right now is also general, but at a later stage will have to be itemized so that the lender is able to know what they are lending towards. And finally, application form signed, which also contains in it the privacy agreement of the lender. Stage 2 is the commitment schedule of the company, ATO portals, the confirmation of mortgage or loan statements if there are any current loans over the existing company or borrower, a confirmation of bank statement, a franchise agreement if in place, previous P&L statements of 2 years, otherwise if the business has not been operating for 2 years, expected P&L for the year forward, and also a lease agreement if it is in place. And finally, an invoice of works, which is itemized now. So no contract can be written up without the invoice of works, and even later, when drawdowns are expected to be made, they will always be based on the invoice. And finally, let us look at the details of the loan. So generally, the interest rates will be 8.5 to 10%, with a 4% brokerage fee added on top of that. If there's only one once-off fee of $399 for setting up, and the payments are calculated monthly based on simple interest rate. The term would be from 3 to 5 years, with no early exit fee penalties, and the loan amount that they are comfortable with are a minimum of $3,000, with a maximum being on a case-by-case basis. Generally, however, where loans are above 250,000, the due diligence requirements go up, and so it's preferable that they are under 250,000. Thank you for listening. This is the end of the presentation. If you have any questions at all, please refer to our BDMs. Thank you.
视频到这里就结束了。如果您喜欢我们的视频，欢迎订阅我们的微信公众号。如果您有任何问题，欢迎咨询我们的微信服务号。如果您感兴趣成为 Zank 会员并享受会员福利，欢迎下载我们的手机 APP。我们下期再见。